Welcome back to Ask the Compound, the show where you ask the questions, we provide the answers. We love the feedback too. Our email here, askthecompoundshow@gmail.com. We're going to use some feedback questions today. Sometimes we have a question, people come back and say, hey, what about this? What about that? We're going to do that today. Questions for today. What happens to a Roth IRA when someone passes away? We're going to talk about a lot of life lessons lately. We're going to talk about the small cap premium. Is it dead? How a backdoor Roth actually works in practice. How to deploy cash on the sidelines for a conservative investor who retired early, and investment strategies for a teacher whose wife works part-time. Now, we always talk on the show about how most of the questions tend to come in for life events, right? Getting married, having kids, retiring. Sometimes people die off. It's a circle of life, right? A lot of people on the show who email about children. I want to, Ben's been pounding the table for years that you start early because compounding takes most of the weight off your shoulders. So Fabric by Gerber Life was designed by parents for parents to make it easy to plan for and manage your family's financial path. With a kid's investment account from Fabric, you can start investing in your child's future today. It's pretty easy. I went through the process today to sign up. It takes like 10 minutes. Join the thousands of parents who trust Fabric to protect their family. Start investing in your child today at meetfabric.com/ATC. That's meetfabric.com/ATC. Plus, these funds can be used for anything: education, summer camps, sports equipment, club sports, all this stuff. Kids are expensive. You always see those stats that say kids cost like $300,000 from the time they're born until they're 18.
I thought it was more.
It's got to be more than that.
Yeah. What would baby Ben have been interested in investing in?
Well, target date funds didn't exist when I was born.
Right. I would make you pick a stock. That's what I'm saying. I wonder what
Cash under the mattress was my investing style until I was a teenager.
Okay.
Oh, and cash under the mattress to CDs to target date funds. Very exciting.
Yeah, very risky there. Speaking of life events, I wanted to say congrats to Mac, who wrote in saying they just got married. And so, yeah.
Oh, we do get a lot of stuff like that. People saying, hey, I just had my first kid, or first kid's on the way. I talked to one of our audience members this week who had twins and wanted a little advice. There's not much you can say when you have twins.
Twin advice.
Yes.
Yeah.
This is true. We had someone email us this week who had quadruplets, 4 daughters.
Wow.
Yes.
That sounds like a reality show.
That's when the financial stuff really matters. All right, let's get into a question.
Okay, up first we have a question from Victor. I was listening to What Are Your Thoughts, and Josh and Michael seemed to agree that the small cap premium no longer exists. I was hoping that this could be discussed in more detail. What is the small cap premium? Why doesn't it exist anymore? How do you know it doesn't? Is it still worth owning small caps? My uneducated opinion was that small caps historically performed on par, if not better, than the rest of the market. With the S&P 500 significantly outperforming small caps in recent years, it seems like being overweight small caps on new contributions isn't a far-fetched or irrational idea. What are your thoughts?
All right, fair question. The Jeremys, Siegel and Schwartz, Jeremy Schwartz has been on this show before. He's a friend of the compound. They covered the small cap premium in the latest edition of Stocks for the Long Run. And they look at the returns from 1926 to 2021, and they show small caps did outperform large caps. It was like 12% per year for small caps, 10.4% per year for large caps. But there's a caveat. They found basically all of that premium of small caps outperforming came between a 9-year window or 8-year window from 1975 to 1983. Small caps were up 1,400%. They're up like 35% per year versus a 15% per year gain for the S&P in that time. Take away that outlier period, and the long run return are actually pretty close. So here's what they say. Here's the explanation for why this happened in that one period. One explanation for the strong outperformance during that period was the enactment of ERISA by Congress in 1974, making it far easier for pension funds to diversify into small cap stocks. Another was the turn of investors to buy small cap stocks following the collapse of the big cap Nifty 50 stocks earlier in the decade. So basically they opened it up. Pension funds could own more. Back in the day, pensions mostly owned bonds, a little bit of stocks. Now they could diversify more. They went big into small caps right at a time when large cap stocks were overvalued. Fair enough. Now you could also say if we excluded the 2016 to 2024 period for large caps, maybe that small cap premium comes back, because you could do this for anything where you take out. But I wanted to look at some other performance numbers, just to see how small caps have held up historically. So I got a bunch of charts here. John, first one, Russell 2000 index goes back to 1979. The S&P is outperforming 12% per year for the S&P, 10.9% per year for the Russell 2000. Now, a lot of people say, hey, the Russell 2000, like 40% of the companies there don't make any money. They're kind of junky. S&P 600 excludes unprofitable companies. This has been around since 1995. And all these numbers go through May 31st of this year. 10.7% per year for the S&P 600, which is 600 small cap stocks. 10.7% per year for the S&P 500, so right on par with each other. Now, Vanguard has a fund that goes back to 1962. It's a small cap index fund. I can't tell you how it was calculated back in the day because there were no index funds, but so this thing has probably changed colors and stripes a little bit, but let's show that one. 1962, 10.7% for this Vanguard fund. It's kind of crazy it's been around for that long. 10.2% for the S&P. Small caps got them there. All right, DFA has a small cap value fund that goes back to 1993. That fund has outperformed by 1% per year, 11.3% for that, 10.3% for the S&P. John, you can do chart off. So I'm sure you could pick some other start and end dates, and you could figure out a way where large caps have done better or small caps have done better, or this part of small caps did way better and this part of small caps did way worse. But over a relatively wide range of results, it's pretty close. Small caps have more or less kept up with large caps or vice versa, right? But they have not over the past 10 years. John, do the next chart here. This is the S&P 600 versus the S&P 500 over the past 10 years. The S&P is up 13% per year roughly. Small caps are up 8.2% per year and have just gotten drubbed, especially recently. So a lot of this is maybe recency bias for people saying, oh, it's dead. And I'm not really in the camp that you should own small caps because you think there's some sort of alpha or factor premium. The stock market and investors are way too smart to allow that kind of thing to persist. If it did exist in the past, let's say it did, it doesn't exist anymore. It's just, you can't make that so I say I look at small caps as providing not a premium in terms of returns, but a diversification premium. So let's look at the cycles of relative performance for the S&P and the S&P 600 since the mid-1990s. John, next chart. Do we have one? Maybe didn't give you this one. Okay, anyway. So what we're looking at, that's on me. I didn't give John our other chart. Yes. So from 1995, I was doing a little last-minute changes here, and I added a chart. That's on me. 1995 to 2000, the S&P was up 250. S&P 600, the small caps were up 120%. Big outperformance. And it's just like this period, right? Large cap tech stocks did really well. Small caps got left in the dust. Then 2001 to 2013, small caps are up nearly 300%. The S&P 500 is up 63%. Small caps crushed large cap stocks for well over a decade. Since 2014 now, we just looked at, the S&P 500 is now crushing small caps. So you could find even similar cycles going back. I looked at the Vanguard Small Cap Index Fund that goes back to 1962. It outperformed the S&P by 200% from 1975 to 1983. Then over the next 9 years, the S&P outperformed the Small Cap Index by 200%. So I guess the way to think about this is like, have things completely changed in the market, or are these things just cyclical? So one of the things that you could say, and this is I think what Josh and Mike were talking about, is listen, companies are staying private longer. There's way more private money available for venture and M&A and leverage buyouts. Plus, a lot of these large corporations are just buying out their competition before they ever even go public. So there's fewer companies that are IPOing than there were in the past. So maybe, and also small companies are impacted much more than large companies by higher rates. So you could look at all these things and say, listen, things have changed. They always say, like, don't ever say it's different this time, but maybe this time really is different. I'm still a believer in diversification because large cap growth stocks are not going to outperform forever. If they did, everyone would just put their money in there and they'd become so overvalued that eventually things would have to shake out. So I am still a believer in diversification into small caps because human nature is cyclical, and I don't think human nature has changed. That's my way of looking at this. That markets they're cyclical, and I think investors always get into this recency bias of the thing that's doing poorly right now, well, it's going to do poorly forever. And the thing that's doing really well right now, it's going to do really well forever. And I don't like to fall into that trap.
I'm interested in hearing about the microcap premium. Is there one of those? Is it like
probably
venture?
Pretty similar. Well, a lot of people say, like, hey, the small cap premium is mostly microcaps. Like a lot of those old returns where it was mostly these really tiny companies that were illiquid and hard to own. And so that's why I wanted to look at more recent data, because a lot of people say, well, the 1920s and 30s data, you couldn't really buy those stocks anyway. They're these like penny stocks on the exchange or whatever. You have to go to a bucket shop. Do
the indexes keep changing the standards for these as companies just naturally get bigger over time?
Yeah, there's like the size of them will obviously increase as the companies get bigger. Yeah. But yeah, so it's possible the small cap thing is dead and they're going to underperform forever. I tend to think that this is more cyclical than anything, and there's a lot of things that have been going in the large cap favor of late. Happy to eat these words in a few years if I'm wrong, but I don't think cycles have gone away.
Okay, cool. So you're saying
Next
go
question.
all in small caps.
Diversification, Duncan, that's what I'm talking about.
I know.
Never go all in.
Okay, up next we have a question from Andy. My wife is 3 years older than me. I'm 50 and she's 53. If I pass and my Roth IRA and Roth 401k go to her, and she does not have a pre-existing Roth IRA for at least 5 years, is there a 5-year clock before she can distribute? I hope the answer is no. If I pass at, say, 57 and she's 60, would she be able to withdraw money as soon as the accounts are in her name, since she would be over 59 and a half?
All right. I told you, circle of life. This is what happens when you reach middle age. You start worrying about what happens to me if something happens to me, or what happens to everyone else if something happens to me.
Yeah.
I'm not in my 50s yet, but I'm
I'm a little
getting
concerned
close.
about Andy. I mean, come on, 57. Give yourself a little more credit.
All right, let's bring on everyone's favorite Roth expert, Mr. Bill Sweet. Roth
Bill.
for life, right across that stomach.
How's it going? I heard 5-year clock, and my ears tingled.
There's a lot of these rules we've talked about. So
Yeah.
people always feel weird about having these conversations because death is not a fun topic, obviously. But I think it is important to understand what happens, because the last thing you want to do, if, God forbid, something happens to you or a loved one, is have these types of conversations then and scramble to figure it out. So having these types of chats now is probably not a bad thing, right?
Yeah, bigger picture, and the way I see things in spouses across the spectrum, right? Men, women, two dudes, two gals, theys, is that usually there's somebody who really has their head wrapped around the financial circumstances of the household, and the second spouse usually less of that, right? So very generally, I think if you're financially the savvy one, I think setting your spouse up for success, just God forbid something happen to you, that's a responsible thing to do, Ben.
Yeah. So what are we looking at here? So that they're looking at the ages. Does that even matter here for passing out, like, take the ages out of the equation? How does the transfer of retirement assets work when one spouse passes away?
Yeah, so that's a really interesting question. And ultimately, you have a lot of flexibility, ultimately. Usually you would want to just sort of check and make sure the first thing to check is that your beneficiary is your named spouse. And what that would do, and God forbid, the case that you predecease, is that you would set your spouse up for success. They'd have one of two options. They could either inherit the IRA or Roth IRA as a beneficiary IRA, or they could transfer it into their own. And that is the second part, transferring it, sort of absorbing that IRA into your own assets. That is only a spousal option. So you don't have that if your son or if your uncle passes away and passes on an asset
So that
to you.
effectively works like a rollover?
Correct, if one instance. And so there might be cases when it would make sense to do that. And a good example would be if, God forbid, there's a death that happens after age 60, right? Because ultimately, once you hit 59 and a half, very generally, you're taking qualified distributions. However, if in the instance that your spouse passes away prior to 59 and a half, which is the example that we laid out here with Andy, then you would probably want to remain that in the spouse's name. So you would become a beneficiary, and then what that would do is mean any distributions you took from that IRA, that would be penalty free, because the person who owned it unfortunately has passed away. So the IRS is not evil in that respect. They're evil in other respects, but they very generally won't penalize somebody for
So it's
dying.
pretty easy. You just keep two accounts instead of putting them into one.
Yep. And the other thing that made me perk my ears up, John, can we chart on the 5-year rule? The Roth IRAs are extremely confusing. There's actually 2 5-year rules that you need to keep track of. So 5-year rule number 1 on the left, for those paying attention at home, there's a 5-year rule clock that starts once you open an IRA, a Roth IRA, and that any distributions that occur within the first 5 years of a Roth IRA, they are not qualified, even if you're 70, even if you're 80, if it's the very first Roth IRA you've ever owned. Sort of when they put this together in Congress in 1995, they wanted to create a long-term incentive for Roth savings. You can't just open up a Roth IRA no matter how old you are and take a qualified distribution the year later. So it's a very easy workaround to this. You just open up a Roth IRA, you fund it with $1, right? When you're in your 20s. And that starts that 5-year clock. It's a once-in-a-lifetime clock, and it's not per account, Ben, which is very important. There's a second Roth 5-year rule that applies to Roth conversion assets, and it's when those conversions can be penalty-free, and each conversion has its own 5-year clock. However, there's 2 5-year clocks, somewhat confusing, and that would probably not apply in this situation, because ultimately you would have the option to treat an inherited Roth IRA as inherited. So it wouldn't be your own.
So this really isn't all that tricky then, I guess. Is it?
Not if you sit down and think about it, Ben. No,
Okay,
I don't
this
think
seems
so.
like a simple one. Duncan, someone in the live chat wants to know if there's an Oatly premium.
If you put if you put Oatly stock in your Roth IRA,
I would say Oatly is the premium choice of oat drink. That would be my take on that. But
Yeah.
based on my account, there's no premium to owning the
Yeah,
stock.
your Roth IRA combusts if you put Oatly stock in there. So
Okay.
I would avoid
I think we have
that.
another Roth IRA one.
Yeah,
Let's do it.
that's what I'm here for.
Okay, up next we have a question from Adam. I'm interested in adding funds to my Roth IRA account, but my income exceeds the Roth limit. I plan to make a contribution each year to my traditional IRA and then transfer it to my Roth. I'm aware that this will be taxed. I've read that you should open a separate zero balance traditional IRA to do this. This would be in addition to my existing traditional IRA that I have used for 401k rollovers. Is this the correct way to go about this? I'm a little
Right, so I
confused
think-
by this one.
I think we're talking about one of the more naughty terms in all of finance, the backdoor Roth IRA. So this is saying like, Liz, I know the benefits. You don't have to school me on those. Just how does this work in practice?
Yeah.
I think that's what they're asking, right?
Yeah.
So is that true that you have to open a brand new clean account?
You absolutely can do that. I don't think that's going to be a workaround. Mr. Adam, if you were to execute the plan as described, you'd be heading right for a taxable Roth conversion. So, John, can we pull up Roth IRA chart number 2? So let's take a look at IRAs. The IRS, Ben, for the purposes of a traditional to Roth IRA, treats all of your traditional IRAs as if they're one. They do not draw a distinction for Roth conversion purposes, whether it's a new IRA, an IRA you've had open for 5 years, or as Adam indicated, what he's been doing is rolling over his 401k into an IRA. And so whether he opens up a new IRA and funds it with non-taxable contributions, that's going to be taxable on conversion, and here's why. If we start all the way in the left hand of the chart, you have IRA 1, $40,000 of earnings on $10,000 of basis, right? We don't want to convert from that because the vast majority of that is taxable. So maybe you have another IRA with $10,000 of earnings but $40,000 of basis. Oh, I'm going to pick that one. The IRS says not so fast. Because if you convert any amount from any IRA to a Roth, whether it's the low basis one, the high basis one, the IRS is going to look at all the IRAs and determine, hey, there's actually half of the earnings here for Adam are taxable, so he's going to pay 50% taxable income on that conversion. So in my example here on the chart, $10,000, $5,000 of that would be taxable. So therefore, for Adam and for Ben and for Duncan in their Oatly Roth IRA, there's no way to separate the basis if you have other IRAs.
Okay, so that's why I make sure that you handle my tax. I didn't even realize that we were doing something illegal here.
Yeah.
Maybe not illegal, but not it's frowned
illegal.
upon.
But if you want to make a $7,000 non-deductible contribution, Adam, the workaround is as follows. You do a reverse rollover. So you basically take all your IRA assets, your traditional IRA assets, roll those into a tax-qualified 401k plan, 403b, 457. Those are not taxable in the pro rata rule. And so once you've done that, then you can safely make a $7,000 traditional IRA contribution, convert that to Roth the next day, and pay no tax. So that's the way to do it. It's sort of in reverse of what Adam discussed.
Is any of this worth the hassle? I'm a simple guy. I keep things simple. I don't like a lot of headaches. Is any of this stuff worth it?
Ben, do you like tax-free income in retirement or no?
I've never retired before. I don't know.
I would argue
What
all.
if he gets there and he hates it?
Yeah, it's like get me back to work. I would argue all of us, Ben, deserve a little tax-free income in retirement, and therefore I would be funding a traditional IRA if they had the opportunity to. In fact, I'm doing this, as is our friend Michael Batnick, who just showed up here for Ask the Compound. Want to say hi. Do that process every year, and what you basically do over 10 years at $7,000 a pop, Nick Majouli's in on this club too, is you're basically funding $10,000 a year. You get $70,000. So $70,000, let's compound that over 40 years, Ben. 70 turns into 140, turns into 280, turns into 250. Like it turns into a lot of money coming out tax-free. I would argue, yes, it's definitely worth the juice.
Right, worth the
squeeze.
hassle. Mm-hmm. But just because you open up some new account zero balance doesn't make it like, I got them.
Exactly.
Right? Okay.
But yeah, the order of operations is really important, Adam. I get those assets into a tax qualified plan first.
All right.
Also, for the record, I'm much more responsible in my Roth accounts because there's no tax loss harvesting. So I own Oatly in a brokerage.
Poor Oatly. We need to find another company.
Oh,
to take
so in your brokerage accounts, you're losing on purpose just for those tax loss harvesting opportunities.
Yeah, it's
But in
part
your
of the
Roth,
strategy.
you don't lose on purpose.
It's part of the strategy.
Me and Bill Arts joke with RWM tax clients. The easiest way to pay less taxes is lose some money, right?
Yeah.
Right.
Don't make anything.
Exactly.
I got it.
All right.
The good
Excellent.
problems to
I think last time we were on the show, Bill, we talked about early retirement. So we got a good early retirement
Oh
question.
yeah,
here.
this is a good one.
Okay, up next we have a question from Henry. I'm 37, and 3 years ago I sold my company for $3 million, not to brag, and moved to Mexico. I was completely burnt out, and I have no interest in going back to the startup world. In addition to amazing people, culture, and food, I can live a great life at a fraction of the price of the U.S.
This guy learned how to hedge inflation too.
Yeah. I don't plan to start a family. I do not own real estate. I'm conservative with spending because I'm not working. I keep half of my money in stocks and the other half in a money market fund earning about 5%. I want to move the cash into a total stock index fund, keeping 5 years of spending in the money market, as the earnings I'm generating cover all of the spending in Mexico, including trips home. That said, yields will begin to decline once the Fed cuts. What's a good strategy to move away from the money market, and what's a good way to do this without losing sleep?
This is an intelligent question and a very good one for someone who retired at that age. Let's do my. I did a meme for this. I did a meme for this guy here. Start up, sell out, bro down, get off the grid. This guy,
Nice.
he's like living the dream here.
Yeah.
Right? He sold his start. He said he there was some more information in this one we had to cut out a little because it's so long, but he basically said he worked his butt off at a tech startup and never wants to do that again. So he wants to set himself up for life, essentially. Maybe go back to work at some point, but not in that sort of lifestyle. So he's got whatever, $3 million, half in stocks, half in money markets. He's going to keep 5 years worth of spending in a high yield savings account, which I think is a pretty as seeing he's a conservative investor, I think that's actually not a bad way to go about it, especially if he's not working anymore, right? He's living off of his portfolio.
Well, I have a question on that note. You just said high yield savings account. He's talking about money market. Is there any meaningful difference between the two for a normal investor?
I like to bucket it as cash equivalents are T-bills, money markets, high yield savings accounts, CDs. Those things are all relatively close. Maybe that you could split hairs and find better yields in one or the other, but effectively similar
To me,
types
it seems
of
like the
all
Winnie the
intents and
Pooh meme.
purposes.
It seems like money market is the fancy high yield savings account.
I'll
Yeah, I
jump
mean,
in.
like, there's FDIC insurance type of things if you want to get
Yeah.
into that. But
That's what I was getting into. One is backed by a bank that typically would be FDIC insured, right? A savings account. I think that's what we're getting into. A money market mutual fund is not FDIC insured. However, usually they are invested in high quality.
But the only
US
time people worry
treasuries.
about FDIC insurance is when there's a bank crisis, and then like 3 weeks later we forget about it.
Yeah, we joke about this, but there was a kind of a serious bank crisis, like as recently as 18 months ago. So I don't know.
But they just changed the rules, right, and cover more.
Well, they have, but again, bank mutual funds have broken the buck, right? If we go back to 2008, the Reserve Fund, famously. So like this does happen. So I think spreading your bets, diversification in money markets makes a lot of sense too. So splitting assets in two ways.
Probably not
makes
a
lot
bad
of
idea.
sense.
So the summary is $3 million, maybe a little more, no dependence, low cost lifestyle in Mexico, not working right now, 5 years of spending, conservative investor, which is the one that stepped up to me. Like if someone says they're conservative, because usually people look at that as a derogatory term. I'm a conservative investor. Most people don't want to hear that about themselves. So like people in finance world like us try to figure out other ways of saying conservative, right? Less aggressive. It just like
Moderate.
Yeah, moderate investor. So he understands he needs to grow his wealth. There's reinvestment risk in cash. Eventually, these 5% yields aren't going to be here forever.
Yep.
And so wants to maybe put it back in the stock market. So I do think the conservative investor piece is part of it in trying to understand, like, he knows, listen, I've got to beat the inflation rate.
Right.
But I guess my question would be going from a 50-50 portfolio to it's probably going to be more of a, I don't know, 90-10 or something, 85-15, depending on how much he has in cash for spending.
Right.
Can you really handle that?
Yeah.
That'd be my question.
Totally.
Is like, you want to be there, but can you handle it since you're a more conservative investor and you're not working anymore? You have no income coming in.
Ben, one thing we tell our clients a lot is if you've won the game, you can stop playing. You don't have to roll the dice. You don't have to take on the risk. So I push on the premise, first and foremost. Like, do you need to take on that risk? And Ben, I think you laid out the boogeyman, which is inflation, right? Which we certainly experienced here in the U.S. Not sure about Mexico. It sounds like lower quality of life, but I would push on the premise. Like, ultimately, if you don't know, diversify. And the clearest way to diversify is to split your options in two, right? Have stocks, have bonds. I think you're going to get decent returns. It'll fluctuate. The only thing, Ben, that I would sort of maybe push on a little bit and maybe think about is that 5-year allocation in stocks and high yield savings. Is that part of that 50% allocation or no? I would argue you could consider it to be. And in which case, like thinking top down the portfolio, what do you want the total portfolio to look like? To me, a 50-50 portfolio is going to perform very similar to a 60-40 portfolio. So I'd push on the premise and say, listen, like what decision led you to that 50-50 outcome in the first place? And if you're not counting the cash that you have, which is very responsible, right, Ben? How many times in market history have you gone to 5 years without taking distribution?
Yeah, that's
from your portfolio?
that's like one of the worst financial crises we've ever seen. Is it going to take longer than that? So
Yeah.
I'm usually more on the aggressive side of things, but I would say if you're going from 50-50 to 60-40 or 70-30, that's okay. But you don't have to go all into stocks just because you're a little worried. And in fact, I would say take it more of a stair-step approach because you're a more conservative investor and see how things go in the next bear market when all of your life savings is sitting there and you don't have the ability to reinvest with more income coming in during a bear market.
And the worst thing you could do, Henry, absolutely the worst thing would be to shift, let's say, from 50-50 to 60-40, have a market drawdown occur, right, and then you shift back to 50-50. This has to be a long-term plan. And so if you're not able to do this by yourself, I would again advocate sitting down with a financial planner, somebody that can hold you, kind of evaluate your goals and give you advice. But ultimately, the worst thing you could do is switch back and forth. Final point for me, Ben. Henry's retiring in like the perfect scenario of the last 20 years, right? You can earn 5% on short-term treasuries.
They don't need to be in a
markets.
hurry.
Yeah, exactly. So like now would not be the time to me to potentially get more aggressive. Now would be the time for me to sit down, slow down, and reevaluate.
So Henry is in Mexico.
Yep.
And when you're in Mexico, you have to drink fruity drinks. So you get a Miami Vice. And we're talking 60% pina colada, 40% strawberry daiquiri, and you put a floater on top for the extra 10. The floater is kind of like his 5 years of spending, right? And that's the diversification you probably need for someone who's trying to ride out 40, 50 years ahead of him. I'm sure he's probably going to go back to work at some point. I can't imagine not going back to work ever. But that's the kind of thinking.
He's living a good
life.
life.
Going to make this last.
I would diversify half Negro Special, half Negro Modelo. So that's more my thing. If I had one of those and double.
You like the darker beers?
Those are good.
That's me.
Yeah.
So the other thing I thought about, and again, Henry, forgive me, John, can we pull up the image that I had? I picture Andy Dufresne, right? So that's Henry heading down to the beach in San Juan at the end of Shawshank
I had to look
Redemption.
it up. I remember when this movie
really?
first came out, I didn't know if that was a real place. It is.
It is, and that's what I picture.
Zihuatanejo is a real place.
I picture Henry working on his boat. So the last thing I would leave Henry with is, look, you're going to be successful no matter what, Henry. So go with your gut. If you need help with a professional, sit down with someone.
Buy one of the banker shirts, the white shirts, and rip the sleeves off. Get some tattered khaki shorts.
Yeah. My guy Tim Robbins looks good at the end of that film. I don't know if you guys have seen that in a while. 94. I was really, really, really upset when Forrest Gump won the Oscar over Shawshank, which was my film.
What's the best movie where the protagonist ends up on a beach at the end?
Boy,
I mean, that's got to be one of them.
it's not The Beach, I can tell you that.
It's
it's got
necessarily
it's
the
up there.
Trading
protagonist,
Places.
but
It happens in a lot of 80s
Office
movies.
Space with Milton.
Yeah, happens in a lot of movies.
Not Rebel Moon. What's the Star Wars flick where they all get blown up by the Death Star? It's not that one.
Spoiler alert.
Yeah, sorry.
right.
It's only
We got
7
one more.
years old.
Okay. Up next, we have a question from Daniel. I'm a teacher and my wife works part-time. We're firmly in the 12% tax bracket for at least the next 4 years. Should I be thinking about capital gains tax harvesting? We received an inheritance last year that doubled our net worth, not to brag, and the majority of this is invested in index funds. I have thousands in unrealized gains. My understanding is that I'll pay 0 on capital gains in my current tax bracket, so I could reset my cost basis. How should I navigate this decision?
I'm always impressed with our audience from knowing tax bracket stuff like this. Like, I think I've asked you this before, Bill. What percentage of the population has any clue what tax bracket they're actually in?
I would say less than 10%. We should
Is
do
that
a
like 5% maybe?
we should do a Duncan on the street. You know, Billy on the street. We should put Duncan walking through Bryant Park right outdoors here in New York and just have him. Hey, what is your tax bracket?
And ask my other question. Do you have a budget, right?
I think someone would attack me if I asked them their tax bracket.
in New York City. Yeah.
Okay, so we're dealing with the inheritance here, but also they say they're because he said his wife is working part-time because she's taking care of a child, which makes sense. And they say they're in the low tax bracket and they could stay there for a while. So how does this work?
Yeah, big fan. So Daniel, thank you first off for serving our country, right, and helping kids out. I mean, I'm picturing Daniel being a math teacher, right, in an underprivileged area. So thank you very much. So John, can we pull up one of my famous charts here on tax brackets? So where I want to point is where Daniel's indicating is that there is a 0% capital gains tax bracket up to a certain amount of gross income, right, that applies. And so this is a married filing joint couple. And if you follow my squiggly big red arrow, you can see right around that line, when it crosses, it's about $123,000 of gross income. So if the income from all of your earnings from work and dividends and interest, and you add it all up, is $80,000, in theory, you have another $40,000 of capital gains or qualified dividends that you can take at 0%. And this is a big cheat code in the IRS. And the big thing I want to highlight there in green is you do do not want to cross that threshold because then the tax rate jumps up from 0% to 15% on those assets. So that's the North Star that I would point to. And to the extent, Daniel, that you can predict what your income is going to be, let's say November, December, I would argue that's around the time that you want to make these kinds of decisions and plans because you have 11, 12 months of data in your hands. Then realizing capital gains up to that threshold could make some sense because effectively, Ben, what you're doing is you're just resetting your cost basis and therefore you're not going to pay those taxes later if and when you liquidate down the road.
So if he's getting close to that level, and if he invested 2 years ago, he might have timed it pretty good with the bear market, then he should probably be careful about realizing those gains unless he really needs the money.
Totally. Yeah, John, can we chart off? The number one thing that I would point to is unintended consequences, though, Ben. So what state, Daniel, are we living in? Like, we don't know that, right? If you're in New York, you're not getting capital gains tax at 0%. You're paying close to 7%, depending on your tax bracket. So I would definitely take a look at the state tax consequences. So that's a real thing. And secondly, if there's any benefits that you might qualify for, let's say college funds, or maybe it might mess up an enhanced child tax credit, you would want to probably sit down with an income tax professional and take all this into account.
But if this is a situation where, listen, we had this inheritance, we need the money for a down payment, we have to take it, then sometimes you suck it up and pay the taxes, right?
Yeah. But doing this over, let's say, 2 tax years or 3 tax years, for the exact reason that Daniel indicates, strategic, thoughtful ways to fill up a bracket, I think makes a lot of sense for a taxpayer. Very, very not commonly used. I don't see this a lot in the wild.
Yeah. And this is also why owning stocks and index funds should be a very long-term hold, right? You don't want to jump in and out of them so quickly.
Yeah. In fact, a couple of years ago, Nick Majuli wrote a great piece about how 401ks are overrated. I think he's changed his mind a little bit, but it's because the market changed, right? So if you go back 2, 3, 4 years ago, interest rates are at 0, dividend rates are at 1.5%. You're just not earning a lot of income. And so therefore, you do benefit from potentially this lower capital gains rate on non-qualified assets. I think the game has shifted a little bit, right? Because of higher income that we discussed in previous questions.
And they have the Roth 401ks now.
Yep. And furthermore, the Roth IRA tattoo I put on Nick Majuli's back when he was sleeping one day.
That helps.
Yep.
All right, we have a bonus question for Bill. I think this is a follow-up from the last ones. Duncan, do we have it here?
We do.
All right. Do it.
Hi, guys. In the latest episode, I heard multiple times a statement made of paying taxes on Roth 401k withdrawals. Am I missing something? It's Roth.
All right, Bill, I wanted you to defend your name here. I think we were talking early withdrawals, were we not?
Withdrawals, yeah, definitely.
Okay,
Yeah.
just wanted to make sure.
Yeah,
and
and
we
just
were
to
talking
hit-
early withdrawals, then you could pay a penalty.
And just to hit the distinction, yes, early is pre-59.5, right? And if you have earnings, and again, Roth 401ks are different than Roth IRAs. Roth 401ks come out pro rata, so you could be paying earnings plus a penalty on a pro rata basis. So relatively complicated. I would argue that's probably the last place you want to go. But tune into Ask the Compound, what was that, 2 episodes ago? We did a great analysis of how to successfully pull that off.
But if you didn't realize that the Roth was tax-free distributions, then, I mean, I'm getting that tattoo removed, so I obviously knew that.
Yeah, or changing it to something, right?
Yeah,
Do-
I'll
do we
pay
have
for
time-
removal.
Do we have time for one more bonus from the chat?
Let's do
Let's
it.
do it.
So Dave Airy says, so Bill, what happens if the Tax Cuts and Jobs Act sunsets?
Yeah, this gets a lot more tricky. Basically, the big picture, Dave, is everybody's paying about 3% more in income tax. I mean, that's the unfortunate law of the land. I guess people on the coast will get really happy because salt taxes might come back. But again, even when I've run it on my numbers, I'm paying 3 or 4% more, and I think most of Americans are too.
So if everything sunsets, that salt piece comes back, and then you can deduct more interest from your mortgage.
But property taxes are more not interest, property taxes,
yes.
and income taxes, correct. However, again, Ben, the tax rates are generally going up across the board, right? 12 resets to 15, 24 resets to 28, 35 resets to 39.6. So it's across the board, this increase.
Hey, listen, people hate inflation. How do you fight inflation? Raise tax rates. That'll fix it.
Great. So
You always have such popular ideas.
yeah, to solve the thing that I'm pissed off about, let me get pissed off about
You know what I hate
taxes.
is government spending. All right, let's tax the people. Wait, what? Oh, no. I didn't agree to this.
So speaking of government spending, got a list here. I would rank the holidays: 5 Thanksgiving, 4 Labor Day, 3 for me is what's coming up at the end? Or not Labor. Christmas. No, definitely Christmas. Christmas in July is cool too.
Did Bill just pull out a Mount Rushmore list here? What's going on?
2, I would rank Independence Day. I would put number 1 on Memorial Day. So what is wrong on these rankings? Memorial Day 1, 4th of July 2. Where would you guys rank? That's coming up in a week. Happy Independence Day to all my Independence heads out there.
I love 4th of July just because I love the summer. But I thought your favorite holiday would be when tax season's over.
It actually is. I was just talking to Bill Arts about this today, where we kind of like wander around on April 16th, like in a daze, wondering what do we have to do that's urgent, and it's nothing. Is the answer. We can like enjoy the sunshine and listen to the birds.
come up for a breath.
I love
Exactly.
Independence Day too, but can we chill with the fireworks a little bit? My dog is like not a fan. He's not doing well, and here in Connecticut, people start doing them like weeks in advance and then continue on for weeks after, just like every day.
I've always been
It's a lot.
anti-fireworks too, Duncan. But now that my kids are getting older, I'm not worried as much about them being woken up. So
Come to
Drone
Ask the
shows.
Compound
Drone
for
shows.
we're pro-inflation, higher taxes, and we hate fireworks and birthdays.
Let's do drone shows instead. How about that? I like that.
All right. Thanks to Bill, as always, for providing his Roth IRA expertise.
A lot of fun,
Duncan,
guys.
new Compound and Friends tomorrow.
Yep, it's a big one.
If you signed up for the Compound Insider newsletter, you'd know who that guest is already. askthecompoundshow@gmail.com is our email here. Thanks to everyone in the live chat. As always, put your questions there. Leave us a comment on YouTube. Email us, and we will see you next time.
See you, everyone.
Happy 4th.